Hi there, hope you're doing great today. Let's imagine a situation where you're evaluating two investment opportunities, one with an 18% IRR and one with a 30% IRR. And if you need a refresher on IRR, please check out one of our prior videos on key performance indicators or the article we wrote about it on dbacapitalgroup.com. And before we begin, as usual, just a quick reminder that our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. For many investors, the natural inclination when looking at these two investments on paper is to gravitate towards the one with the higher return. In this hypothetical example, the 30% versus the 18% IRR. But is that 30% IRR investment really better? As usual, the answer is it depends. The higher the risk, generally speaking, the higher the return that one would require to be appropriately compensated for taking on more risk. So in the specific example, we may be comparing a stable value add multifamily opportunity to a new development multifamily opportunity. While in and of itself, each one may have its merits, with the new development, there is inherently more risk involved, especially in the early stages when the operators are obtaining the entitlements, all the permits, effectively doing what's known as the horizontal construction. And even when they go vertical, in other words, when they start building the apartment property from the grounds up, there's still execution risk, budget overrun risk, other operational risks that may occur throughout the duration of that project. That is not to say that the project would be unsuccessful, but in exchange for taking on those higher risks, then the investor would typically require higher return to be compensated for that exposure. In the stable value add example, there are risks involved as well. However, in that case, the property is already there existing, so the core risk revolves around operations. The ability of the operator to execute on the stable value add plan and navigate successfully through various market conditions. And while there is a risk as well, in that case it's slightly lower because you're not dealing with effectively having to permit the existence of that building and then eventually being able to put it in existence, which is a much higher risk. So for that reason, one gets compensated, but with a lower return level. So next time you open an investment offering and look at those glossy returns and are trying to weigh in and compare investment opportunities, don't only focus on the returns, but also on the underlying risk, what it is, how is it mitigated, is it appropriately mitigated, and is it within your comfort zone. We hope you found today's video helpful, and if you did, please like, share, and subscribe, and we'll see you at the next one.